Hello from Chicago and welcome to Stockcharts TV. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. The title of today's presentation is History Suggests an Emerging Buying Opportunity. Today, my focus is on the current major downtrend in the U.S. stock market, which has been driven by expectations for upcoming tariffs and the fear of inflation that these tariffs bring, according to most economists. Adding even more uncertainty to the party is that last week there was pressure from the White House on Fed Chair Jerome Powell to lower interest rates in an attempt to bolster a weakening U.S. economy. It even threats to fire Powell if he didn't comply. This coincided with an almost 400-point collapse in the S&P 500 between April 14th and 21st. This week, 2 days later, President Trump came out in the press and said he has no intention of firing Chair Powell and that the press, quote, ran away with things. The S&P 500 responded by opening 140 points higher on those comments. So the circus continues, and with it, all the day-to-day market noise and volatility that go along with it. In today's video, I'm going to take a step back to look at the market from a more intermediate term standpoint to see if we can draw any historic parallels to other similar stress points in the market over the past 10 to 20 years. First, I always like to begin these stock charts videos with a review of what we talked about the last time, so we can kind of get a through line from where we were the last time that I was with you, which was on February the 28th, to where we are now. It just seems to make a lot more sense to follow that kind of attack. The title of my video on the 28th of February was A Minor Pullback or the Start of a Much Bigger, Nastier Decline. I was really afraid of the latter at that time, which ended up materializing. So let's do a little recap from that February 28th video, and we're going to change views, and we're going to go to stock charts. And we're going to begin with this chart of the S&P 500. On Feb 28th, we said that our Asbury 6 tactical model had turned negative on February the 21st. First, we should probably have a look at that first. So this was what you saw on Feb the 28th. It was our Asbury 6 internal market indicator. This is updated every day after the close. And basically what we did was when it became more difficult to tell what the condition of the market is by looking at the S&P 500 and some simple indicator like volume or something of that nature, I built a indicator that used 6 different inputs that measured the internal strength of the market 6 different ways. And we back tested this. We went back 6 or 7 years on the back test to try to get a better day-to-day understanding of what the real condition of the market is and not getting jerked around by the S&P where it's 100 up 100 today, down 100 tomorrow. Makes it really difficult to hang on to a good idea when there's that much market noise swirling around you. It seems to be more and more frequently every month. So we built this indicator. 4 or more of these metrics that are green or positive indicates a bullish bias for the model for the Asbury 6. 4 or more red is a bearish bias for the model. So this is what it looked like when I was with you on Feb 28th. It had actually turned to negative on February the 21st. Again, indicating weak market internals, warning of more tactical market weakness. And except for about a week during the last week of March, the Asbury 6 has remained bearish since then, while the S&P 500 declined by as much as 19%. We also said the S&P 500 was breaking support at 6,000, which warned of a deeper decline. That takes us back to the stock charts chart that I want to show you. This was the chart that we had displayed on October the 28th. We said that because the market was already up 75% since October the 22nd since October of 2022, up 75% since then. This emerging decline could turn into something significant and scary, I think were the words that I used. So this is the chart. Obviously, when I was with you, the chart ended right about here, February 28th. You can see the red arrow there. We set if the S&P 500 declined below 57.73, which was this support level here, then we're going to have some real problems. SPX subsequently declined by another 13% into the April lows being down here. So we basically broke down about a week after I was with you. We came up to retest that 57.73 area as a resistance zone, and then the market fell apart. Then the index fell apart. We also pointed out a bearish chart pattern in the Nasdaq Composite Index, which is the larger of the two Nasdaqs. Let's have a look at that chart. So again, this is the chart that we showed. We wanted to show that this investor indecision area in the comp was broken down from on February the 24th. So here's the 28th, right in here. And we said that this chart, this breakdown, it targeted a move down to 18,100. And we said if we got to 18,100 and we hit this target, the index was in big trouble, especially while it was underperforming the S&P 500, as shown on the lower panel. You can see we broke down from the pattern on the 24th of February, but on the 21st, this is a relative performance chart down here in the bottom of the Nasdaq comp versus the S&P 500. You can see it started underperforming SPY or SPX on the 21st here as the relative performance line broke down below the 63-day moving average. So this was just added angst for us. And you can see that since then, the comp declined by another 22% into the April lows. We also looked at NVIDIA, which is the third largest U.S. stock according to market cap. Let's move over to that chart. And again, this is the same chart with just a lot more data, about 2 months of data on the back end since I was with you last. So we pointed out that NVIDIA has maintained a tight and stable positive linear correlation to the S&P 500 throughout the past 25 years. So as goes NVIDIA, thus was likely to go the U.S. market. We pointed out that NVIDIA was breaking major support right here, which is the 200-day moving average in orange. So we broke down through it, and earlier in February, tried to rally, failed, and we were coming right back down here again on February the 28th. What bothered me even more at the time was that NVIDIA had been underperforming the S&P on a quarterly basis. This is the 63-day moving average here in green since the end of January. So we already had the relative weakness that made this more scary for me, more meaningful. NVIDIA subsequently collapsed by an additional 31% into the April lows. This was a 31% move here. Now you can see we're starting to recover along with the rest of the market. So now let's look forward into the rest of the second quarter. That huge market decline into early April resulted in a test of major support in the S&P 500 at 48.19. So let's look at our next chart. It's a 5-year chart of the S&P 500. And what we see here is the January 2022 high, benchmark high here at 48.19, is also coinciding with the major uptrend line drawn from the COVID low down here, which was March of 2020. Huge support level. What we're not going to show here just because of time considerations is that we also we're testing a major support level in the Dow 30 at 36,950, and at the same time in the Nasdaq 100, which is the large cap part of the Nasdaq top 100 charts according to market cap, that level was at 16,765. So we had three different major U.S. indexes that were all testing long-term support levels. Now, the test of this major support in these key indexes coincided with the spike in the VIX, which we're going to look at next. So this is the VIX going back to 2020. And what we're showing here is when we get a spike in the VIX above 38, this is going back the past 4 years. Some of these are a lot over 38. Some of them are right up to 38. But that has indicated an extreme in investor fear. And with that extreme in investor fear also comes, oftentimes will come an exhaustion, a selling exhaustion in the marketplace as everybody just kind of throws in the towel. You could see we had that big spike in March of 2020, which was the COVID low. We had a couple more here in the latter part of 2021 or of 2020, early part of 2021. We had a big one here in October of 2022. We had another one on August 24th of last year, and we have another one now. So we've tested some support levels amid this kind of exhaustion in fear. Meanwhile, S&P 500 has also simultaneously reached quarterly oversold extremes that have coincided with or closely led every significant bottom in the S&P 500 since 2009. And for that, we're going to look at the S&P 500 up top here and a 63-day RSI. There's 63 business days in a quarter. And what we see right now is that we're at this low extreme of a little bit over 30, and that we've hit that 1, 2, 3, 4, 5 more times going backward into 2008, 2009. March of 2020 was the low that we made during COVID. We had another important low in December of 2018, Feb 2016, Sep 2011, and then the March 09 bottom in the S&P 500. So these are not timing tools. These do not say, I'm going to buy the market right now. These say that historically, somewhere in this neighborhood has historically been where the market has had kind of an exhaustive capitulating move down and has started to find its footing again. In addition, the S&P 500 has also reached most bearish extremes according to the AAII sentiment data. AAII is the American Association of Individual Investors. I've spoken at their chapter meetings all over the country at various times over the past 5 years. They're older, they're wealthier, they're really more fundamentally oriented rather than technically or quantitatively oriented, and they're very risk averse. They're older people that want to hang on to their money. So let's look at that chart also from Stockcharts. So there's different variations of this indicator. This is the percentage of market bears, the most bearish that they are. So you can see we're at a most bearish extreme, really going all the way back to 2016. This is about the most bearish. This in October of 2022 are about the same. But I kind of drew a line of demarcation here. That's the green horizontal line. And you can see that this is lined up with most of the important bottoms that we've had over the past 10 years. So we've got major support levels. We've got signs of exhaustion by multiple different types of indicators. So the question now is, what's still missing? What do we need to do now to indicate that this environmental situation has turned into a buying opportunity? Well, we need improved market internals. For that, we're going to move over to AsburyResearch.com. We're going to go into the Research Center, which is the paywall for us, and we're going to go to the Asbury 6. So the Asbury 6 is a daily data-driven gauge of the U.S. stock market's real internal health according to 6 diverse metrics, which we selected via quantitative backtesting. The reason that we built the Asbury 6 is because the market's a lot more jumpy now than it was 10 years ago. We kept the Asbury 6 internal for a few years. It was my way of making sure that I didn't get faked out of a good idea because the market was down 100 one day. And I started second guessing, my bullish thoughts on the market. And then 3 days later, we're making new all-time highs. I'm sure that's happened to everybody here. We built an indicator to keep us from doing that. 4 or more of these metrics in one direction indicates a directional bias for the indicator. We just turned back to 4 as of the close yesterday. So we are 4 green. 4 or more red is negative. We've been negative effectively since February the 21st with very little change to that. So now we're turning back to positive. What does that mean? It means that the market is starting to look better internally. It's starting to heal itself internally. 6 constituents of this: rate of change in the S&P 500, relative performance between stocks and bonds, investor asset flows, volatility, trading volume, and market breadth. Very diverse. But during the back test, these indicators are different enough that they do a really good job of picking each other up. If 1 or 2 of these indicators is late or it isn't really working well in the particular environment that we are in, those other 4 tend to pick it up. This is updated every day about 2 hours after the close in the research center. It's active. About 11 round turns a year since 2017. However, since 2017, it has stayed dead even with the S&P 500 with very little fluctuation for that entire period. In other words, giving you the S&P, but the S&P 500 has had a 34% maximum drawdown during that period since 2017. Maximum drawdown on the A6 has only been 13.6%. So that's the beauty of this indicator. What we're missing is our CPM indicator, correction protection model, which we're going to next. This is our model. This is our model that we actually use to manage money for our clients. We manage money for individuals and also for other RIAs. It's a third-party advisor. The CPM is still risk off. You can see the CPM right here. This trades a lot less. This trades about 5 round turns a year, annualized since 2017. And you can see that we went to risk off in middle December of last year, back to risk on really quickly about the middle part of January. We're back to risk off on February the 25th. We stayed risk on for about a day or two when the market was starting to look better in the latter part of March, and we've been risk off since April the 2nd. So we haven't gotten that signal there yet. CPM has stayed right on top of the S&P 500 with about 40% less risk according to maximum drawdown beta and standard deviation going back to 2017. The last thing that we want to look at is, second to last thing that we want to look at is where's the resistance? Now that we know that the Asbury 6 is showing that market internals are starting to get better, but we still don't have that confirming shift back to CPM, to risk on in CPM. The next thing we want to take a look at is where's the resistance in the S&P 500? And so we're going back to Stockcharts here. And tactical resistance for us is at 54.03. We're at 54.45 right now as we speak, as I look at our monitors. 54.03 to 55.05 is the September 6th low of last year and the March 13th low of this year. And it's not shown on the chart, but the 21-day moving average is also in there as well. If we can get through there, that's going to be the price confirming the strengthening internals that we're seeing in the Asbury 6, and that may come with a move back to risk on the CPM. If that happens, that's going to, the way that we look at markets, identify the April 7th low as a tangible bottom, a bottom that investors can lean on as we look for the next move higher. Hopefully there's more consistent messaging out of the White House that helps us to get there. And this is major resistance now. This was major support when I was with you last. We talked about the 200-day moving average. That's now up at 57.48. So let's say 57.50 to 57.70 would be the next target if we are able to break this 54.03 to 55.05 overhead resistance that we are testing right now. The last thing we're going to look at is we're going to go back to the research center and, okay, what do you buy? If we are bottoming here, where is the money going in the sector space? For this, we go to our SEAF model, Sector ETF Asset Flows model. There's more information about all of these models right here at asburyresearch.com, up across the top. This is our SEAF model. Our SEAF model measures the velocity of money moving around the 11 sector spiders, and we built a scoring system, a mathematically derived scoring system. Right now, the money is moving into financials and utilities and real estate and moving out of technology and consumer discretionary. So right now, we're looking at financials, utilities, and real estate as places where the money is surging into and that we are looking at as potential places to participate in if this does indeed turn out to be an important bottom at the April lows and a new move higher. So there it is. The benchmark S&P 500 reached a condition of exhaustion in and around April 7th. That can be seen in many technical and quantitative metrics, including volatility, investor sentiment, and price momentum. However, we are waiting for this breakout through the primary technical resistance level that we just showed you in the S&P 500, currently being tested, amid improved market internals according to the Asbury 6, and we're still waiting on the CPM to tell us further indication that we've got a significant market bottom in place at the April lows. From a sector standpoint, our SEAF model is currently indicating that investor assets are most aggressively moving into financials, utilities, and real estate as shown here, and continues to most aggressively leave technology and consumer discretionary. Finally, just a little bit about my firm, Asbury Research. We offer 2 tiers of investment research for professional individual investors. We have a premium product that includes all of our models, which we're looking at right here when we were in the research center, and our model portfolios. We also have a free newsletter on Substack. It's asburyresearch.substack.com. There's a free newsletter there. There's also a very inexpensive newsletter there for $25 a month, which gives you a very small subset of what you're seeing here in the premium. We are also managing money for both individuals and other RIAs. Asbury Research is an RIA, and we offer 4 different model portfolios with different levels of risk reward to manage those portfolios. If you need information on any of that, go to asburyresearch.com here, go to the contact tab, tell us what you're interested in, and we'll get back to you with whatever information that you may need. Hope you found our ideas and analysis useful today, and we will see you at my next video for our friends at Stockcharts.com. Thanks for watching, and have a great second quarter.